Revelations from my man cave. My name's Jeff Banks from Property Portfolio Solutions, and today I want to talk to you about one of the simple traps people fall into when it comes to claiming deductions for interest on their investment properties. Right, now, a lot of people will have their house here, you see where I've drawn that before, and they'll have their mortgage. Right, while they're paying it off, the interest on the mortgage is not deductible because this over here is their principal place of residence. Now, I'm going to go in and buy an investment property. If I do things the way that we would suggest, we would then borrow an extra cell of equity here, so another mortgage secured over this property, but the intention was to buy this property, so the interest on this particular mortgage is tax deductible, and so is the mortgage over here for the rest. We do this so that we have less than 80% here and we don't have to have mortgage insurance. So do that, not a problem. We try and make this one here interest only. We have our interest offset account down here, saving ourselves money against our non-deductible mortgage, and that's all well and good. The problem comes when people have a line of credit and they start doing the same thing. So they say, well, hang on, my line of credit the day I'm going to do the investment transaction is the balances here, so I'm going to take this much out of it and put it into the deal. Right? That makes this amount of the interest on this particular loan tax deductible. What it doesn't do is maintain the deduction at the value of this particular part here, because as we're making repayments on this line of credit, the tax department want us to assume that the whole loan is going down, not just this part here that was secured over our principal place of residence. Then, if we get this down to a particular point and then we re-borrow more money then for, say, the boat, because that was a private portion, again, the percentage of the loan changes from being significantly business or investment oriented to being more personally oriented. So we just need to be careful that the calculations, if we're going to run this sort of borrowing idea around how we're going to do our investments, we need to make sure that the calculations are done right. I've seen a lot of people get into trouble because they think that, well, hang on, I borrowed $300,000 out of my line of credit, and that 300,000 times the interest rate is always deductible. That's not right, because the evidence doesn't show it that way, and evidence is everything when it comes to tax. Now, you should be talking to your accountant about this sort of stuff. Being an accountant for more than 40 years, dealing in this sort of stuff, we tend to shy away from this sort of structure because it's much better to put things in little envelopes that fit specifically within the project. We also make sure that there's a structure in place to ensure that the risk involved in any particular investment is limited as much as possible, and that everybody has the legacy that they're looking for. When it comes to the taxation of investments, and particularly rental properties, you need to be careful you get it right. There's so many pitfalls, especially if you're playing here, that will increase the cost of your accounting fees, because the calculations involved here relate to every repayment that have been made and every withdrawal that come with it, to change the percentage of the interest that is claimable. Here, if I've got an interest only one in a separate cell and the mortgage over here, it's really easy. I can have 100% or more than that, because if I borrow the 20% plus the stamp duty and what have you and the other on costs, I can have a leverage of more than 100% on my investment and get the tax deduction accordingly. It's all about playing the game and playing the game properly. Now, I've had 40 years experience in this. Other accountants have probably got as much experience as I have, and they know that this sort of thing, but you need to ask the question, when I'm going to invest, am I doing it right? Am I going to give myself a mess like this? It's better to be prepared. You know, the Scouts, and I used to be a Scout leader, be prepared is absolutely critical when it comes to investing in property and claiming tax deductions and showing the incomes that we're making as we're going along. My name's Jeff Banks. I'm from Property Portfolio Solutions, where your legacy is our inspiration.